Hi there, welcome back to the second element of the fourth unit of our course, Research on Corporate Transparency. As I indicated in the last session, now we are talking about one of my favorite papers all time. This is the paper by Grossman and Stiglitz in the American Economic Review in 1980 on the impossibility of informationally efficient markets. I thought that, hey, to honor this paper, why not label the element exactly the same? So here we go. Yes, we build on the last unit, obviously, or the last element on market efficiency. And I hope that you recall, or, here's the news. Market efficiency is depending on assumptions. So whether market efficiency can materialize in markets depends on certain assumptions and expectations. And sufficient conditions for informationally efficient markets are developed already in the original pharma study. And these are, as we discussed, no trading costs, no transaction costs. Information is available at no costs, and all investors are rational and have homogeneous beliefs. So if the market is structured as such, then we should observe informationally efficient markets. But obviously, you see that all these assumptions are rather rigid. So I think it's worthwhile to study the how important these assumptions actually are. So can we be more lenient? Can we find other sets of assumptions that also give rise to informationally efficient markets? And here is where Grossman and Stiglitz step up to the plate. So they take one assumption, which I think is also the assumption that you could argue is the most crucial one, and that information is available for all investors at no cost. So this zero cost assumption is pretty far away from reality, like every teacher knows. So producing knowledge is costly. Knowledge is required in order to obtain information. So meaning that, well, yes, there is a cost in getting informed. And so now let's see whether, if we assume that the cost of information is there, that we can still derive properties or other assumptions under which then markets would still be informationally efficient. I think this is a very clear, let's say, research program or research question that Grossman and Stiglitz look into. And for us as accountants, I think it should be, super core interest. Okay, so let's look at this. So what do? They build a market with a risk-free and a risky asset and a set of investors. These investors have homogeneous but incomplete information, right? So they are all identical, and they have the same level of information, but they are aware that this information is incomplete. So now they can obtain new information, but this new information is costly. So this is now the variation, let's say, of the assumption. So the information is costly. But besides of that, investors are still rational. And here comes the all-important bit. They can learn from price. Yeah. So since they're rational, you would expect this, right? But based on the information that they have about the modeling setup and, the information, so especially the information that there is other information out there that some other investors might have obtained, they can observe the price, and from learning from the price about maybe the likelihood that other people have obtained information, other traders, and also about the nature of this information. So they can learn from price. So this type of modeling is relatively typical. There are many papers in economics and financial economics that use this type of model setup. It's been called a rational expectations equilibrium model. So the idea here is that the market participants form rational expectations about how the price should develop, conditional on the information environment, and in the equilibrium, these expectations need to be fulfilled. So this is the basic equilibrium process here in this model. And when you take this model and then you can relatively quickly get a feeling for one of the major outcomes of this model, and this is this information paradox here that you see on the slides. So the information paradox, we will talk about this also on the next slide in a little bit more detail, is as follows. So let's assume that the market is really strongly information efficient. So all information out there is being priced. So if this is the case, and I, as an investor, can learn from the price, and I assume that this is the case, so that the market is strongly informationally efficient, why would I acquire costly information? Because by definition, I assume that this information is already being priced because somebody else has obtained it. And if somebody else has obtained it and it is already reflected in price, why should I bother to spend out money to get actually the same information that has already been impounded into price? So prices, reflect all available information. Perfect. So that should be cool, right? So now, if this is the case, then why would I bother? Why would I obtain this information? And then nobody obtains this information anymore. And then this means that prices lose the ability to reflect all information because nobody is obtaining it anymore because everybody is assuming that somebody else has already obtained and priced it. So meaning that the price becomes informationally inefficient. So this results in mispricing, and these mispricing again generate incentives for information-based trading. So this is the information paradox, and I will try to visualize this a little bit more with this wonderful graph here. So let's start north. So at the top. So meaning that we are in a situation where we have a market, which follows the Grossman-Stiglitz assumptions, and too few investors are informed. So prices are not very informative. Market participants observe this, and they have an incentive to get informed. So they have an incentive to shovel out the extra money to get the information because they can trade on this information. And by trading on this information, they can break a profit. Okay, so they do this. So they become informed and they start to trade, and this moves the market. So the price changes. And now we are basically in the south part of this wonderful image. So now uninformed investors see the price move, right? They observe the price moving and they say, this looks as if somebody has obtained additional information. And for us, this is important because we learn something about the underlying value of the assets that we are trading, this risky asset, right? So now what we can do is we can actually, to some extent piggyback ride on this information and actually trade according to it. So this then, in terms, reduces the informational disadvantage of the uninformed investors. So they learn the same information, or, it's not the same level of precision, but they learn the part of the information, let me put it that way, from the price process, and that reduces the relative advantage of the informed investors and triggers them to reduce their amount of information acquisition. Because on the margin, it's no longer beneficiary for them to obtain the information given that others can actually trade on their price. And this reduces the amount of information acquisition and goes back to the north case. So we have too few informed investors. So now this is the process. And Grossman and Stiglitz asked the question, well, can there be an equilibrium in such a process when cost is larger than zero, where all information is actually being impounded into price? So can there be such an equilibrium, or is such an equilibrium not obtainable? So they set up the math behind this paper is not trivial, right? But I think the way that they develop the argument is very nice. So I very strongly motivate you to read the paper. So they start with a set of conjectures that are very general. And then they say, okay, these conjectures in a general way, they're not able to test, but they're able to test them in a way where they put a little bit more structure on the utility functions. And in this setting, where they have a little bit more structure on the utility functions of the investors, they can show that there is no such equilibrium. There is no such equilibrium with positive costs, so costs larger than zero, where all information actually gets impounded into price. And this then leads them to this wonderful quote in their conclusion, or in their summary, I think, where they say, efficient market theorists seem to be aware that costless information is a sufficient condition for prices to fully reflect all available information. See? They are not aware that it is a necessary condition. Meaning that, well, if you are in a market where information is not costly, if information is costly, you will never ever have an informationally efficient market. This is important. Okay? So let me try to summarize a little bit what this means. Yeah, and then this short, wonderful element is already done. So as we are living in a world where the production of information is costly, markets will never be informationally efficient. Yeah, so information is costly, obtaining information is costly, means markets will never reflect all available information. Okay? The more efficient they become, the smaller is the investment or the incentive of market participants to actually acquire information. And this has an interesting effect on liquidity, which Grossman and Stiglitz also talk about. So as markets become more homogeneous in terms of information and beliefs, and the information costs become lower. So as all these market properties become more and more attractive from a market efficiency perspective, so information cost is low, there's little divergence in beliefs, information is being very homogeneously distributed. At the same time, liquidity dries out because all the incentives to trade are being removed, other than, let's say, consumption, right? So this means that there is actually no reason for such a market anymore. So you can also understand this in a Hayek way. Yeah. So if everybody agrees on everything, why would you even have a market? Yeah. So the stuff is being allocated along people. Everybody's happy. Yeah. We don't need a market anymore. Right. So meaning that the very reason why markets exist in the first place, the divergence of information, is actually clearly indicating that the markets will never reach this informationally efficient state. If they would reach an informationally efficient state, at the same time they would cease to exist. Yeah, so this is important. Yeah. So now, what does this mean for us then? So first of all, obviously, the markets will never cease to exist because they are always, let's say, plagued by heterogeneous information, right? So there's constant new information arrival. There's constant change in information acquisition cost. Even if acquisition costs go down, you can think about, let's say, the last 50 years as a period where information costs declined dramatically. But at the same time, also the wealth of information that is available basically exploded, meaning that taken together, still information was very costly to obtain. The new information. Some of the old information was becoming very easy to obtain, but new information was again highly complex, hard to process, and costly to produce. So markets will always be, striving with this new information arrival thing. And then also one thing that is important, I think we can assume that information acquisition costs will vary across market participants. And this has a very important distributional aspect to it. So meaning there will be some market participants that have it relatively easy to obtain new information, and they will always be at a, let's say, somewhat competitive advantage over market participants that have it relatively hard to obtain this information. And this results in information asymmetry on markets with distributional properties that we don't have to like. Yeah. So, if the uninformed people are also rational, then they are aware of their competitive advantage. And this is also something that we will address in the next, and final element of this unit. This information asymmetry effect can unlevel the playing field and maybe lead to, again, liquidity effects because the uninformed investors withdraw from the market, and this is also problematic, right? So this is the situation. These are capital markets. They're pretty far away from the CAPM model that you study in your undergrad, or the idea that markets are informationally efficient and you are price protected as an investor and you don't have to worry about fundamental information, right? So here we have a situation where you can think about markets more as a competition over information and over efficient means to generate information. Okay, so very different understanding of what a market is, I say. Okay, so now, so again, this is of course on corporate transparency and not on market microstructure and asset pricing. So what does this mean for us as scholars that are caring about corporate transparency? So on such a market, you can think about the role of financial reporting or wider corporate transparency as two different things. So the first thing is, well, you have the task to increase the level of information that is out there for market participants. Maybe there is information that simply is prohibitively costly to generate or to acquire. without financial reporting, and financial reporting can actually reduce the information cost. Yeah, so this would then translate into increase the level of information that is impounded into price, make this all more precise, increase information precision. Okay, and the next time, the second task, and this is related but different, as you also will see in the next element, I hope, to reduce the information asymmetry on the market. So, meaning that make sure that the information cost not only declines for some investors, but for all investors. So, meaning that it is easier for all investors to become informed. So, this is the idea of leveling the playing field. What is also, very almost a constitutional objective of the Securities and Exchange Commission in the U.S. So, and this idea is also extremely important for financial reporting. So, I like to say that financial reporting in this regard has some aspects of socialism, because it tries to reduce the inequality of information across market participants. Yeah? And I like this. Yeah? So I happen to like this idea to think about financial reporting in that way. Yeah? So we want to make capitalism honest, and we want to make sure that all investors have the same level of information. By the way, making capitalism honest is not by me. I think this is something that Sir David Tweedy said at some point, if I recall correctly. Okay, anyhow, this is it. This is what I wanted to tell you about Grossman and Stiglitz. As I said, a wonderful paper. A paper I loved even before I was aware that it has been written, because I remember as an undergraduate student in economics, I always listened to these wonderful neoclassical market models, with marginal costs and so on, and I always thought, this cannot be true. So if this is going on, so why would anybody do anything in such a world, right? Everything is netting competitive zero, and everything is transparent, everything is clear, all information is equally distributed. Why would anybody trade? And this, these were thoughts that I had in my mind, when I was listening to these classes. And then years later, I actually came across Grossman and Stiglitz, and I thought, now it all starts to make sense. Okay, anyhow, love it, love the paper. Thanks for listening. And see you in the next element, I guess. Cheers, bye.